I've always been a pretty enthusiastic supporter of regional development in the UK generally, of which Scotland is one part. And there's actually quite a lot of interest expressed, and a lot of people are asking questions about Scotland, as in an email says, well, listen, what if they have this referendum? What do you think? How do you think it's going to play out? As if I know, as it were. Or they say, look, we're thinking about doing something in Glasgow, but what's your outlook for the next 5 years, as it were? And so there's actually quite a lot of interest, and I think partly because there is a story to tell in Scotland. And I'm gonna throw out a few ideas today. There's no way. I think, what did I call the title? Scotland: A Few Market Observations. I think if I were going to redo the title now, I would call this presentation "It's Not Political, It's Cyclical." Okay, so that sounds quite positive. I'll show you what I mean, and we'll jump right into the property things and tell you what I'm thinking. The first thing I want to look at is investment volumes by value in the regional markets over the last several years, just to show you how Scotland is faring as compared to the rest of the regions. And the blue in the background is all ex-London investment. So you can see it came off a little bit last year like the rest of the UK market did. If you look a bit more closely, you can see in dark blue that the Northwest seems to be moving from strength to strength, as does the West Midlands. But you can see that, oh dear, Scotland seems to be somewhat down, as it were. It's not. If you dig into the numbers a bit deeper, though, it tells a different story. This is all about Aberdeen, right? Aberdeen was turning over around 800 million per year for several years, and then in 2015 it turned over about 150 million, and then last year it squeaked out about 50 million. If those numbers would have been in the total figures for Scotland, they'd be pretty much moving in line with the rest of the UK regions. And I think part of that is there's a few things happening in terms of the investors base going into it. You're getting a lot more foreign capital coming in. You're even starting to get institutions that are finding local asset managers to set up JVs and even get into a little bit of development, dare I say. And I think the perception that may have existed 5 or 10 years ago, that there's only so much you can do in any particular regional market because the liquidity is limited and there's not necessarily a clear exit all the time, I think that's being overcome. There's been some pretty big chunky assets have been trading in various markets, and so I think it's actually increased the appeal of the regional markets in general, and which I think also explains why people are asking questions about Scotland in terms of investment opportunities. Let's go to the next one, thank you. All right, so then I thought to myself, well, okay, if it's Aberdeen, it all has to be about oil. So I started looking. I got some purchasing manager indices over the last, since January 2014, because I wanted to capture the impact of the Scottish referendum too. And I think this is really interesting. Let's look at London in purple, magenta. You can see when the Scottish referendum came, it actually took a little bit of a dip. But when the EU referendum came, it went deeply negative and was consistent with, if you tried to link it with GDP, it would suggest that we were going to go into a period of recession. So everybody was a bit alarmed there for about a month. But as you can see, it bounced right back. There's a lot of reasons for that I don't want to go into. But also, if you look at the UK as a whole, it was down quite considerably. But look at Scotland, it didn't even move. All right, it came down a little bit, but it seemed to be marching to some other tune. And even if you go back to the Scottish referendum, it never fell below that threshold of 50. Everything above 50 means growth. Everything below 50 means contractions. And this is basically all sentiment driven. So this is a survey that's based on purchasing managers being asked about their order books and their prospects for business, right? So I stuck the price of oil up there, and sure enough, there's a pretty close correlation, which would suggest to me that after the referendum, when there was this period of weakness, and which has remained in Scotland over this whole period, it suggests to me that perhaps it has a lot less to do with sentiment based on whatever political issues there are to think about, and it really has far more to do with the price of oil. And when I started digging into the Scottish economy a bit more, you always think of Aberdeen as a bunch of guys with duffel sacks, going out with chains and doing stuff. That stuff died years ago. It's a far more sophisticated offer now, but also the integration of industries that rely on petroleum, whether it's refining in other parts of Scotland and other sort of petroleum-derived products. It's a huge part of the Scottish export business, and I think actually explains a lot of this general sort of weakness that we've seen over the last couple of years. Next slide, please. So I stick up Scottish GDP as compared to UK GDP, and the remarkable thing is that it's cyclical, just like the UK is. And if you look way over on the right-hand side, I go up through Q3 only because the Scottish national statistics stop there, as it were. But you can see that we've had in Scotland about 5 or 6 quarters of pretty weak quarterly growth as compared to the rest of the UK, which is a little bit stronger. And I think this all has to do with oil price. Next one, please. So I started looking at the economy and what it consisted of in Scotland, and it looks an awful lot like the rest of the UK. So on the far right here, you can see that over 60% of the economy is household spending, so consumerism and the like, all sensitive to interest rates, by the way. The other one is around 20% for government spending. This is what GDP consists of. Investment, interestingly enough, in Scotland seemed to be marginally higher than in the UK. When I think the snapshot is from Q3. Net trade, like the rest of the UK, is negative, and so I thought, well, it doesn't look much different in that respect. So then I decided to get into the net trade figures and see what the export exposure was. And clearly you can see Scotland in blue has a much greater export exposure than the rest of the UK, even on the imports too, which would suggest to me that if there were going to be price pressures or volatility that would come into the Scottish economy, it's probably going to be more vulnerable to that than the rest of the UK. Hence, if oil, a commodity, fluctuates widely or the prices go down, it's probably going to feel more of an impact than the rest of the UK. And I think that goes a long way to explaining some of the underperformance that we have, rather than lack of business investment due to limited positive sentiment, for one way of putting it. Next one, please. Yeah, so I did try to do a little bit of science here, and I matched oil prices with Scottish gross value added, so sort of a measure of GDP, and I came up with a staggeringly high 0.94 correlation if you lag GVA, that is GDP, by 1 year. That is, if oil prices go down this year, then next year the Scottish economy will probably perform a bit more weakly. And you can see in 2015 and 16 that the prices come down quite considerably, and sure enough, we've got a sort of a flat period that seems to be emerging. There's preliminary numbers coming out yet, but we don't have the hard data out yet. That'll come soon enough. Okay, so that's why I'm thinking that it's looking a little bit more cyclical than political, as it were. Next slide, please. All right, but let's look at Aberdeen. And I can remember some time ago I got a question. I get a lot of questions on my jobs. And an investor said, we're looking at Aberdeen. It was about maybe 4 or 5 years ago, and we're really curious to know what Aberdeen looks like without oil. And I said, you're not serious, are you? And he said, yeah, we're serious. We just want to cover all contingencies and all the rest. So I've done all this analysis of the structure of cities, how much is in distribution, how much is in retail, how much is in financial services, how much is in manufacturing, to get sort of a snapshot of what all the cities around the UK look like. So I said, okay, fine, let's go to Aberdeen, let's pull the oil out and see what it looks like. Looks just like Southampton. So that is to say, it has a distribution function, it has a university and the like. And so, on the back of that, they said, well, then maybe it's not such a bad place to invest after all. I don't know what they knew well, I certainly didn't, nobody expected the big collapse in oil prices, I suppose. But I thought it was an interesting question. But the thing about Aberdeen, I made the joke before that it's not a bunch of guys in duffel bags anymore. And actually, when you look at Aberdeen, despite it being linked to the oil, it's becoming a little bit less cyclical. All right, I know that sounds like a bit of a reach, given that office space is on its knees and there's not much leasing demand, and rents are falling quite considerably and all the rest. But this data here in blue is sort of mining and quarrying employment, which has come down in the early 90s and remained fairly low. But what has increased is professional, scientific, and technical activities. Now, and this forecast goes out to 2029. This comes from Oxford Economics. And I think that the whole idea here is that the Aberdeen economy isn't necessarily, strictly speaking, linked to North Sea oil production, although there is a lot of that. And there's also a huge decommissioning that's going to have to be undertaken for several years too. But it's become a center of expertise and consultancy globally. All right, the company may well be based in Aberdeen, but they're probably doing the consultancy in the backside of Africa or Asia or wherever happen the work needs to be. And that part of the business has grown really quite significantly. And so in that respect, it seems to be even a little bit less cyclical. And I would argue that given some of the pricing that we're seeing on office buildings now, up in double-digit yields for what theoretically should be a grade A building, it's got to be a buy opportunity if you buy this argument that I've been putting across. And there's some people that are looking at it very seriously. Next one, please. I told you that I sort of looked at the structure of cities across the UK. It was part of a plan to try to explain to myself why the UK regional cities weren't getting as much investment as, say, the German regional cities. And there's a long story about that, which I don't want to go into. But what I decided to do is, again, use this economic tool to try to look at cities that were specialized and the cities that were not specialized and see how they all compared. Because I think the basic argument goes that if you have a specialized economic offer in an individual city, it's very likely to be a high value add type business, whereas if you don't have specialized, you're probably going to have low value add. Now the risky bit about having high value add industries is that if anything goes wrong, i.e. the oil price collapses, then suddenly you don't have too much else to fall back on, and the economy becomes very volatile, right? On the other hand, if you have a non-specialized economy, like Glasgow to a certain extent, then you have a lot of lower value add industries, and the downside of that is you don't get the big uplift, but the good side is that your eggs aren't in one basket, and so you get a lot less volatility. And in fact, when I spoke to the investor the other day that said they were interested in Glasgow, this was the exact reason why he said that he was interested in Glasgow, is because of the broad mix of economic activity, suggesting that if anything went down, there'd still be plenty left to maintain demand, which I thought was quite interesting. So when I started running the numbers, and this data is about a year old, but it hasn't changed much, I looked at the average economic structure of the big 6 cities in the UK, so Glasgow, Edinburgh, Birmingham, Bristol, Leeds and Manchester. And it turns out that Glasgow was the most average city in the UK in terms of economic mix, as it were. Clearly, if you look at Aberdeen, it's a couple of standard deviations out from this mean. It's highly specialized, as is Edinburgh, which of course has the financial services sector, as it were. And then you kind of come around, and pretty much from Manchester on, they're all pretty close, to be honest with you. And so maybe it's a bit unfair to pull Glasgow out as being the most average city. But if we dig down a little bit deeper and look at Edinburgh and Glasgow, it tells you the same story. You can see that the average is in the middle, and Edinburgh has positively more financial services than the average, whereas Glasgow has positively more of a public sector as well as business and administration. So it doesn't have a specialty is what the real focus that comes out of it. And if there is, that top category business and administration also includes call centers and what they call marketing functions, as it were, which I think is why there's a bit of a surge there. So the question is, and I was talking to Anne Murray about this just the other day, that I think in November the report came out, the economic report on planning for Glasgow, and there was clearly an attempt to try to detail what the comparative advantages of Glasgow were, with the aim toward trying to find new specialized industries so that you can get this value add kicker, as it were, but also not trying to sacrifice the economy to make one super volatile. So you hang on to your basic generic mix of industries, but you really focus in on a few that will give you that little extra punch. This comes from Scottish Enterprise, and essentially there's several organizations that were doing this across Scotland. They're doing it in Edinburgh. I don't know about Aberdeen, to be honest with you, but the Scottish Enterprise, I know, is thinking exactly along these same lines. What does Scotland have that it can push forward that's going to provide opportunities for growth and everything? And I would have to say that, within the context of what's happening in the UK generally, in terms of devolution and all the various regional entities trying to go through the same process, I think that Scotland is well ahead on that game and has a pretty clear message. The other thing to think about is the population issues. Scotland has an aging population, and if I throw up this chart, which is forecast from Oxford Economics for the next 15 years, you can see that while Edinburgh on the right has good population growth and the working age population is growing, Glasgow has a declining population at the moment, or not declining, but the working age population seems to be forecast to contract. And I think a lot of this, and this was recognized in the economic report too, So the target of these industries is also to provide a firm base to actually attract talent and keep talent in order to grow the working population and, well, ultimately, if you want to be cynical about it, to grow the tax base so that you could do lots of interesting things in the country, I suppose. But I would say, too, that investors look at this sort of material, and they also look at the investment offer as a whole and ask the question of whether there's a coordinated attempt to, push the agendas of these cities forward. Next slide, please. And so there, Ernst Young had the UK Attractiveness Survey done at the end of 2016, and what's really amazing about this is that it shows this phenomenal growth in inward investment. This isn't just property. This is across all the business pieces, I suppose. Scotland up 51%, Northwest up a staggering 118%, Yorkshire up, Northeast up, London up a marginal 7%. Listen, London's done. It's time to do some stuff in the regions. But I think what was really interesting is one of the questions they asked in the survey is, will this policy of giving more decision-making power to, they say the English regions, but all regions, make them more attractive from an investment point of view? And the resounding response was yes, 42% said it would make it far more attractive. Now, I interpret this to mean that if you, at a local level, through devolution and the ability to do your own strategic planning, you can bring in all the local stakeholders, both on the private side, the public side, education, and all the rest, to actually plan out what you think is the best going forward, and who best is going to know it other than the local stakeholders. Then suddenly you can put together a pretty clear marketing message that I think is going to be of great appeal to inward investments of all variety, including property, and I think that's what this is telling us. We'll see how it progresses. Certainly in England we've got the mayoral elections happening in May for the West Midlands and all the rest of the local combined authorities that have signed up to the mayoral model, and I think that's going to give it a big impetus. I think the West Midlands is going to be pretty active over the next year because I think like Scotland, they have a pretty good plan. Next one, please. But then we get more. Let's bring this around to property now. The thing about regional investment and the thing about the type of offer, I think certainly that Glasgow had with the regeneration, these aren't your sort of private equity type opportunities where you come in and swashbuckling with your sword and do something in 2 years and you're out. It's hard to see clearly what the exit is, except that it's going to be slightly longer term. I would say a minimum of 5-year play, and actually it might be considerably longer than that. Just observing what's happened in places around the UK that I literally walk to get to the various offices that we have at Colliers. I've watched Birmingham transform before my eyes into something that was, listen, wasn't very nice 15 years ago. And now you can do a nice run from the train station all the way over to Brindley Place, and it's actually pleasant and interesting looking even. But look, that's taken 10, 15 years, And so attracting the money in, and I think this is a real question maybe for the panel too, who probably know more about the investors than I do. I don't know, it's hard to say. I know a good few investors. How do you tap into, say, the institutional fund money, which tends to be a little bit more long-term, but which is a bit risk-averse, to get into the sorts of development projects and that are going to play out over 5 to 10 years rather than over 3 to 5 years? And I think that's a really important question.